should you own? It's a question which often comes up, and what I've realized is a lot of people simply get this wrong. So like I said, I'm going to start the live broadcast in just a second with all of this. So the big question for today's live stream: how many stocks should you own? How do you filter for quality? A lot of people know they should be investing in the stock market. A lot of people know they should be putting their savings aside and letting Apple or Amazon or Costco deliver returns for them, but they don't do it, okay, because they don't know where to look and what to do. So I'm going to try and solve that problem in today's talk. I'm going to start off by showing you the portfolios of Bill Gates, Carl Icahn, George Soros, and so on. Okay, these are billionaires, as you well know. Let me put that onto full screen, okay? Now, these are incredibly wealthy individuals, and as you would expect, whoops, let's go back there. As you would expect, they've got some stocks they hold, obviously. But what might surprise you, and I'll just take you through this, you can see the names of the individual, Bill Gates, and so on and so forth. There's their portfolio value in millions. So you've got 202 billion for Buffett's portfolio, 17 billion for Bill Gates. You might say, well, wait a minute, Bill Gates is worth a lot more than that. I'm talking about his portfolio, not what the valuation of Microsoft is. But look at the number of stocks, and that's the important thing you need to see. The number of stocks, there's 23 there. So wait a minute, he's worth 17 billion and only got 23 stocks. Most private investors I know end up with 40, 50, 60. Why? Because they read something here, they read something there, and they just keep buying different stocks. They're chasing the market. They don't have an entry strategy or an exit strategy. So here's one for you. Hold for 12 months and review. Have 15 stocks is the correct number. If Warren Buffett with 202 billion only has 44, then the issue is really solves itself. We should be having far fewer than we often do. But Alpesh, won't that lead us to be overexposed? And by the way, feel free to put any messages into the chat as well. Won't it make us undiversified? After all, we've been told it's great to give your money to a fund manager because they'll invest it and spray and pray into 100 stocks. No, these are the top 10 holdings. And by the way, even though Bill Gates has got 23 stocks, his top 10 holdings pretty much account for most of his portfolio, because you can see holding number 10 is only 1.82% of his portfolio. So you can see under there, under those figures, there's the Bill Gates one, 23 stocks. Those are the names. Holding number 10, top 10 percentage holding number 10 is only 1.82%. So really, he's actually getting most of his results from 10 stocks. And you've got to assume he's got some very clever people advising him. So we'll come back to that in a second to make my case that you do not and should not have hundreds of stocks, even more than, I'd say to most people as a rule of thumb, about 15. So let me bolster that case some more. After all, when we look at this map, which is the IMF's projections for next year and growth, we see that the markets, the global markets, are going to be growing a fair bit. Let me just share that with you alongside. You can see, I'll just spotlight it actually. You can see there's going to be massive growth in parts of the world where we've not seen growth at these levels. The UK hasn't grown at 4% since the post-war era. The United States, 4.7%. So we would expect equities and profitability to jump up. Okay, that's what we'd expect to happen, right? Seems the obvious thing. As what's likely, and therefore we probably want to try and get our portfolios in order. Like I said, you look at all of the opportunities out there, given the growth that the IMF is predicting for next year. Okay, this is the IMF projection, so we know. And also, and this is from McKinsey, when it comes to the stock market, do we have room for optimism? Well, what they've put on the y-axis, and I'll blow that screen up. What they've done on the y-axis is the virus spread and public health response. Okay, that's on the y-axis. The better the public health response, the more quickly we expect a recovery. And on the x-axis, knock-on effects and economic policy response. All right, so the better that is, the closer we get to a V-shaped recovery, which is this bit up here. Okay, it's that bit up there. There's your V right up there. Now, if that's going to be the case and we get this V-shaped recovery, which economies are there? Well, most of our economies have had maybe a mediocre response, public health response, and policy initiatives have been quite good in actual fact. They've been pretty effective. So you're looking at something as in block A2. Remember, this is the McKinsey analysis of it. Again, another reason to assume that, yeah, we really ought to be looking at equities for next year and what to get into the market in that time frame. So if that's the case, and by the way, backed up by other data as well, which suggests, yes, we get these massive epidemics and global stock market problems and difficulties, but in the end, we get out of it. Okay, well, that just out of interest shows you, yeah, we do tend to get out of those difficult moments. One more reason to be positive and looking at getting these right number of equities and what we should be looking at, well, this is the S&P 500, pretty much like a 2009 pattern. That's sourced from Morgan Stanley and Bloomberg. Again, we seem to be following that pattern. We're going and rising. In fact, we're at all-time highs already in the market. Guess what? In the 12 months after the stock market hits an all-time high, the 12 months after, and I've got the data on my other screen, tends to be another rather good 12 months for the market. Subsequent 12-month returns have averaged 12% in US equities since the 1960s after an all-time high has been hit. Well, an all-time high just got hit. So another reason to be having more of these stocks. Now, the reason I say people get the number of stocks in their portfolio wrong, either they have too many, and I showed you Warren Buffett's portfolio and Bill Gates' just a moment ago, and I'll come back to it. Some people go the other extreme, and they have too few. Look at this data. I'm going to blow the screen up again. Look at this data. Okay, this is from the Bank of England. The Bank of England says when it comes to the UK alone, let alone the United States, Hong Kong, Singapore, other parts of the world, 1.5 trillion pounds of cash is stored in savings accounts spread across investment accounts, ISA, savings and current accounts, according to the Bank of England, equal roughly to the combined value of all UK residential mortgages. This is money which is not being invested and could be costing savers billions. Of course, you want to keep some money with the certainty of a bank account's returns, which are 0% returns, but the certainty you're going to get your money tomorrow. The stock market doesn't give you certainty. But by not investing, it's costing people a better pension, a better retirement. It's costing them in terms of opportunity cost. Okay, and that worries me when that happens because, again, out of ignorance, they're not doing anything. And part of what this talk is about is removing some of that ignorance. And then, of course, we hear talk about, oh, well, we're at an all-time high, record highs, there's a bubble, bubble, bubble. Well, let's look at the data. We've got used to looking at data during COVID. Let's just look at the data. This is the NASDAQ 100. Okay, and I'll blow the screen up again. This is the NASDAQ 100. Okay, in blue from the years 1995 to 2000, and in white from the years 2015 to now. And you can see by comparison, actually, we've not risen anywhere near the bubble territories that we've had with tech companies before. And by the way, don't forget, when we had the tech bubble in March 2000, okay, when we had the tech bubble in March 2000, it was when metrics which we're using were not to do with profitability of companies. It was like, how many users have they got? How many people have they got using their website? How long do they stay for? As opposed to profitability. At the moment, we're rewarding technology companies based on profit. So I'm less worried about the tech stock so-called bubble and boom. What worries me instead is the poverty gap between those investing globally and the line at the top. Again, I'll blow this picture up. The line at the top, NDX, is the NASDAQ, just as an example, and it's over the last 5 years. Okay, so you got the NASDAQ, which is up about 128%. You've got the S&P 500, more broadly based American stocks, up 53%. And you've got people who might only be investing in their domestic markets of maybe the UK. I'm from the UK. And one reason I tell people in the UK to look and think global for their SIP, their pension, their ISA, or if you're in, I don't know if you're watching this in China, you're watching this in Singapore, wherever you're watching this in the world, look outside your domestic market, is because of the problem of the poverty gap. What happens is your domestic market generally tends to underperform. And you can see this with the UK market. It's down 12% over those 5 years. So all those fund managers trying to sell you UK only funds or Europe only funds, well, you know what they're doing? They're selling you junk. Instead, if you yourself had picked those global stocks, and even if you just tracked an index, my God, which I don't recommend, but if you just tracked an index like the S&P 500, which is fairly wide, you would have avoided that poverty gap. My point with this poverty gap is the American who invests in his domestic market gets richer than the Brit who invests in his domestic stocks. Now, being British and patriotic, I want to own stocks around the world. I want to be imperial in my thinking. I want to own a bit of Apple. I want a bit of Square. I want a bit of Costco. I don't just want to be looking at companies just because I happen to live in a certain geography. And I said in my talk yesterday, I'm not racist when it comes to picking stocks. I don't care what nationality the companies are. I just want my pension to be growing. So we want to avoid that poverty gap by ensuring we don't simply stick to our domestic markets. By the way, if you want to learn more about all of this, free copy of my book, you can get it from my website, alpeshpatel.com, a free copy of my international bestselling book, Investing Unplugged. And there are other reasons why I think you, the private investor, should be your own fund manager, have those 15 stocks. And I'll show you the free tools on the internet where you can sift through stocks. Remember my numbers, 12, 15, 25. Hold for 12 months, 15 stocks. If they drop 25% from the highs they've been, exit. Hopefully none of them will drop that much, but exit. The other reason I think you can be your own fund manager is this. With me and my big mouth, the FT asked me to prove it, that a private investor such as myself, as I was in 2004, can beat institutional fund managers. So they ran a competition. There you go. And that's the competition. And I did. Okay, I came top to forecast the FTSE. And I said, if I win, you better put me on the front page of your business section. Actually, never mind if. I said, when I win. Neil Woodford, sorry to mention him. I don't want you giving your money to fund managers. I want you to be your own fund manager. I want you to pick those investments, okay, instead. Because, well, we get sorry tales like this all the time. And we in the industry know private investors are on a hiding to nothing when they just are giving it to farmers. Hi, Angus. Hi, Nimesh as well. Angus said, interesting concentration of assets. Is it? Is it really, though? Sometimes people go, oh, you've got too many tech companies. Do you really think that Apple and Square are the same company? They're not. So in actual fact, that concentration, and I think what you're talking about is if you look at this, it's not concentration. And I'll tell you why. So if you look at Bill Gates's portfolio there, okay, let me blow that up on screen again. And you look at some of the other portfolios, and I'll zoom in a bit more so you can see the numbers. Right? Oh, he's also concentrated. Why are the billionaires, the idiots? What do they know about making money? Why are they just in 23 stocks there or in 44? They're so concentrated in stocks. No, they're not, for a very simple reason. That if you instead divide your wealth of what you're going to put into stocks into, let's say, 100 stocks. Let's go to one extreme. Let's go into 100. And I'll show you the statistical reasons for my arguments in a second. But let's just do a simple experiment. Into 100 stocks. And let's say you divide it equally. So you've got 1% in every stock. Let's say you pick a really good stock. Okay, well, you've only got 1% of your capital in it. Great. What difference did it make? Okay, so what's the number? We know the number's not 10 stocks because that's probably too few stocks, and any one will have too much impact. In actual fact, it surprises people when they see why the wealthy put it into just, say, 23, or billionaire like Buffett into 44, or Leon Cooperman into 41, or Bill Ackman, love the guy, 8 billion under management in 7. Oh, is it because they're massive gamblers? Well, if they were gamblers, they would have not been billionaires by now. They would have blown their money. So when private investors with a couple of thousand instruct the billionaires on how many stocks they should hold, it's really worrying. It's really, really worrying, okay, as well. Got some more questions coming through. Warren Buffett said if he had to do it all over again, he would stick all his money in S&P 500. I think what you mean is he would, and by the way, there's a reason for that. He would just track the index. And the reason for that is his tracking the index, there you go, 53%, would save him a lot of time, energy, and money. But he's also been lagging the index, I think, for the last 14, 15 years. Now, that's because he's got so many billions to manage. For the average private investor, they don't have billions to manage, so they don't have the same problem. And here's a graph effectively a typical bunch of 15 stocks. Now, obviously, if there were only all oil stocks, this chart wouldn't look like that. But as you increase the number of stocks, the diversification benefit, in other words, the volatility of average movements, the movements of your portfolio each day, each week, each month, the diversification benefit vanishes after about 15 stocks. Maybe you can go to 20. Maybe if you don't like those numbers, maybe you've got so many millions to invest, you go up to 25 stocks. But on the whole, one of the reasons that people prevaricate with their portfolios, hold on too long, is because they've got too many stocks. Therefore, it gets too complicated. Therefore, they can't be bothered. Remember my numbers, 12 months holding period. If it drops more than 25% from the peak, get out of it. We're keeping it simple, okay, and have about 15 equities. Now, this is a general rule. I mean, if you're a 90-year-old who's in critical care and needs their money to pay taxes tomorrow morning, obviously you're not going to be investing in stocks to begin with. Okay, so I'm saying as a general rule, people tend to buy too many or too few, and they, as I said, prevaricate. But the big question then becomes, well, what the hell should they be buying? How do they decide? So let me give you some numbers. Okay, I've already made the case why it should be global. I don't think you should be monitoring them frequently because psychology shows that you will start fiddling and you will get in and out. You'll panic at every sign of news. So 12 months is the period, okay? 12 months is the period over which I think you should be holding, okay? You should hold over that period. Now, one screen's all you need, all these flash screens. Like I said, 15 to 20 equities. Now, I'm going to give you some of the tools in a second, the free ones that are available to narrow down those stocks. I think you're diversified if you've roughly got 15. Yeah, I've got Square, I've got Apple, I've got Amazon, and people think, oh, that was highly concentrated. Well, not really. Also got Costco as well. The fact of the matter is, I wrote about this in one of my FT columns a few years ago. When the markets fall, everything is correlated, sadly, with the exception probably of Bitcoin. But forget that for a moment. In other words, when we look at correlation and think, oh, we'll just increase the numbers, what we're actually trying to do is trying to avoid being indecisive. Be decisive. 15 of those equities, and I'll show you how we filter them in a second. I told you about if it drops 25% from the peak, we'll get out, add quality, and take profits. So we only want to pick the quality companies, and we'll take the profits within those 12 months if they drop 25% from the peak. Don't do it between 9 to 5 when the markets are open because you'll get too overexcited. And it should take about an hour to filter through. What can we use to filter? Well, actually, there's free tools out there. Look at this. This is on Yahoo Finance. They've got an equity screener with, look at all these tools you could choose. Now, that begs the question, well, which of these factors should we use, Alpesh? We want to have some factor of valuation. We know value is important. We know, for instance, Altman, I think, is important. We want to avoid companies with a high bankruptcy risk. So Altman, you can learn about it more on Yahoo anyway, or Google Finance. There's other providers. I also, therefore, want to be looking at valuation. I want well-valued companies because research shows a company which is undervalued tends to perform better than an overvalued one. But we know some companies are undervalued because they're rubbish. So we want companies with good valuations, lower valuations on a screener like this, but with higher growth, because growth companies tend to do better than ones which aren't growing as a general rule, except they fall off a cliff. So we want to make sure they're undervalued growth companies generating an income, because companies generating dividends as a general rule tend to do better than not. So value, growth, income, momentum. I want ones which have been performing well over the past year. Cash flow. Okay, so you've got a whole bunch of measures here. I won't go into all of these, but you're not going to tick every single one of these boxes, but you can pick one or two valuation measures. I want you to pick cash flow. I want companies with growing cash flow. Why? Because research shows companies with growing cash flow tend to, as a general rule, do better than ones which don't. You know what the mistake private investors make? The mistake private investors make is time and again, they'll try and gamble on the news instead. Oh, this company's got rubbish cash flows. It's absolutely destroyed during COVID. Let's take a gamble. It'll go up next year. No, go to Ladbrokes for that. Okay. So the screeners, we want value, growth, income, cash flow, average returns to be positive. And then you can play around with it. There's a lot of different ones. This is free. This is Yahoo. Oh, it's just one I picked up. I'm not promoting it for Yahoo. I'm just saying they're one who've got, let's see if I can zoom in a bit, if that helps. Yeah, there you go. There's many of these available on the internet. Okay, so that'll give us a bit more of what we know how many stocks, and I've made the case for that, and we know, okay, not just how many stocks, but we know how we might narrow down and find them. Now, somebody's asked me, how do you trace the impact of renewable energy sector on the investment portfolio? I don't. I'm looking for companies which show, because I want the share prices to go up. Okay, my portfolio is there to make me a return. Therefore, I want companies which are going to give me, which are low value, high growth, income generating, average returns are strong, etc. So I don't actually look at that specific fact. Like I said, if you want a copy of the book, free, absolutely free, just go to my website, alpeshpatel.com. Okay. Thank you, Angus. My pleasure that you're on. Now, what I do at the end of each one of these talks, I go back over what I've done, just to recap in case you missed any of those screens. Like I said, this is my case for 15 stocks. It's not my only case. I've got more statistical cases. But like I said, if you've got too many stocks, the chances of you prevaricating and not then trimming your garden, as it were, at the end of 12 months is increased, because you'll think, oh, where do I even begin? Where do I even begin? And I say 12 months because it's a good number. Again, there's some research to back it up. 20 years holding a stock is too long. Lots happens in the world in 20 years. 20 minutes is too short. What's the number in between? That's where I've come up with 12. Now, great question. Jazz has asked me, and a few people have asked me this. Actually, my sister from Florida asked me, what about Airbnb? That comes down to the issue of IPOs. Okay, there is some research to suggest you should stay away from IPOs. Then again, we see some great ones. On the whole, I tend to stay clear of IPOs, I'm afraid. If you're absolutely insistent, I've written about this again in my Financial Times column. If you're absolutely insistent at looking at IPOs, and the reason I stay away from IPOs is because there's not enough data coming to me, public data. Okay, so if you absolutely want to, then wait till the end of the first day, see where the actual issue price is. If the stock dips below it over the next 1, 2, 3, 4 days, only get into the IPO after it's recovered back above the issue price. Okay, do you understand that? So because very often they shoot up, then a load of people, and that's when you end up buying at the maximum, and then people sell against those profits, and it goes down and you've overpaid. Instead, usually, and again, there's some data to suggest, they drop below their IPO price. When they recover and go back above the IPO price, issue price, then get back in is a better strategy as well. Thanks, Simon. You've still got your copy of Investing Unplugged for the hard copy I gave from ages ago. So just running through back, now I want you to be your own fund manager. And the reason is, like I said, if people like me can beat people like Woodford, who's got billions. The world in 2004, having trounced him in a public forum like the Financial Times. What happened? And by the way, and then the next year I set up my hedge fund. He set up his long only fund. He's lost all his money. I haven't. Okay. My point is, as a private investor, I want you to manage your own capital. Please don't just assume the so-called experts know everything. They don't. Manage your own. Keep it simple. Use the screeners, 15 stocks, 12 months. Okay, and then review. You will do better than the fund managers. The average typical UK fund will take, out of every £10,000 you give them, every 5 years will take 10% of your capital in fees. Look in their small print. It'll show you. Every 5 years, 10% in fees you'll be paying away to the fund manager. The fund manager who will merely track the index. Now, if he's tracking the FTSE, then he's delivered you 0% performance since 1999, because the FTSE's at 1999 levels. So don't do that. Okay. And the reason I want you to go global and international, as I've already said, is this: the poverty gap. What you see is 5 years of NASDAQ in blue, S&P in orange, and the UK markets in red. Don't just do domestic stocks, i.e. UK stocks, because you'll have this poverty gap. You'll have missed out on the American markets and global markets as well. And I want, as a British person, you to own global assets, not just UK listed stocks alone. I want you to own them from around the world, have those people in those countries working for you and paying you in dividends and share price rises, and spend your money in your local Lidl or Poundland. Okay. The point being, there's a poverty gap if you're American, because what you do is you earn lots more because you invest in your domestic market instead. This chart to show there isn't a bubble. Blue is the NASDAQ in the 5 years to 2000, and white is the 5 years to 2020. Well, on a percentage basis, we're nowhere near any kind of that. Jazz has said, I thought it would just me, impossible to find credible data on IPO. No, on an IPO, they have to issue a prospectus. It's got data. But what I mean is, because it's not listed on the stock market, it hasn't got the kind of stock market data because it's not listed. It's a private company. So the data, that's why I tend to stay away from IPOs, not least because the first day pop, which is engineered by the investment banks, means that if I did put a buy order in, I'll end up buying at the pop well above the market. Now, one more reason, like I said earlier on, that I want you investing and not just keeping your money in an account is this. Look at it. More than £1 trillion of money is costing savers, according to the Bank of England. That's how much money is in bank accounts doing nothing. So one more reason to have at least one stock, for God's sake, okay, for the sake of your pension. And to go backwards on that point, next year seems like it's going to be a fairly good year. This is from McKinsey and the data that I showed you earlier on, which was saying that if the public health response is good, I think it's been fairly good in most countries, but let's say it's mediocre, but the financial, fiscal, and monetary intervention was strong, then we're at A2, and A2 suggests we get a sort of V-shaped, U-shaped sort of curve. But in actual fact, the terminology I love the best is somebody said K-shaped. And what K means is this. That's sort of a letter K. There's about 10% of companies doing incredibly well. Those are the ones we want to be in. And there's a whole bunch who are going to do rubbish. Well, we want to make sure we're out of those, okay? In sort of closing, that was the IMF. That's their projections for next year. And in case you can't see it, I'll just zoom in. It looks like it's going to be one hell of a year. And it's also what Paul Tudor-Jones, the hedge fund manager, said for next year. He expects it to be quite a bumper year. If you go to alpeshpatel.com, you'll see that you can join my Telegram channel for free. On there, I post some of this data as well regularly, actually pretty much daily. And you can get a free copy of my book as well. So if you go here we go. If you go to alpeshpatel.com, you can join the Telegram channel, and at the same time, you can. I'll show you where it is. You scroll down. It's here. Okay, that's my Telegram channel. You just click on that. You'll get free access to all of this data here, and you can get my free copy of my book there as well if you go to alpeshpatel.com. Okay, right, guys, I'm going to go. Thank you all for listening in. For anybody who missed it, ask me any other questions you've got. Ask me anything, actually. There's the Bill Ackman, Bill Gates, and Kyle Icahn portfolios. You can see their portfolio value, the number of stocks, and you can see their top 10 holdings. Okay. Any other questions that I've missed from anybody? Angus, you met Ackman. Wow. And so's Jazz. Wow. I wish I had met him. I've never met him. Where do you find this info on? If you go to my Telegram channel, I'll post it on there. My team gets me data from various sources on what people are holding. Ultimately, it comes from the SEC filings, and then my team puts it into a palatable format for me to look at, so I can look at things on this. Okay. Any other questions? If not, I'll sign off on this, and I'll try and do one every single day. Oh, by the way, as a treat, I'll leave you with the Dow, and I'll leave you with my assessment of the Dow 30 stocks and the ones with the best and highest ratings. I'm going to share that with you because I just sent this to my sister in Florida. She asked me, what should I look at? And so this is based on the factors that I told you. You screen through valuation, growth, income, momentum, cash flow, returns. Sortino and Alpha, I won't go into in this, but essentially the ones with the more greens, the better. The more greens, the better. Okay. Thanks, Jazz, as well. KCL2, good. All right, guys, I'll leave you with that shot, and I'll try and do another one fairly regular. I'll try and do another one tomorrow, but here we go. There's me. Let's go. That's it. That's what I'm looking for. Thanks all for everybody for listening in on this. I really appreciate it. Hope you found it useful and valuable.